Good morning, everyone. Welcome to the Greening Central Bank's Peer Learning, Innovation, and Insights webinar. We're going to give one more minute for our audience to join in and start. A very good morning, good afternoon, and good evening to everyone present here. On behalf of United Nations ESCAP, NDC Partnership, Agence de Développement Français, and the European Investment Bank, I extend a very warm welcome to all of you to our webinar, Greening Central Bank's Peer Learning, Innovation, and Insights. My name is Anand Jha, a project specialist in sustainable finance with the United Nations ESCAP, and I will be your moderator today. This webinar builds on the feedback received from 18 central banks who participated in our first peer learning exchange titled Greening Central Banks Learning from Experience, which was hosted by our same partners today in 2024 and will be hopefully the first in the series of such exchanges this year that brings together regulators, experts to deep dive into the topics of greening central bank. To start the proceedings, I have the pleasure to invite Ms. Isabel van Grunderbeek, the Head of Unit of Financial Inclusion Advisory at the European Investment Bank. Since 2018, Isabel is leading a team in the financial sector experts managing technical assistance and advisory programs for EIB Global. Prior to this, she worked with the EIB on investments in West Africa and the Maghreb, heading the Regional Representation Office for West Africa from 2014 to 2018. She has also served as an infrastructure specialist at the African Development Bank, where she notably launched the Program for Infrastructure Development in Africa. She's a graduate engineer from Supélec, France, and holds an MBA from IMD Switzerland. Isabel, the floor is yours.
Thank you very much. Ladies and gentlemen, good morning, good afternoon, or good evening. It's a great pleasure to welcome you to this second peer learning webinar co-organized by the European Investment Bank, the NDC Partnership, Agence Française de Développement, and the United Nations Economic and Social Commission for Asia and the Pacific. We're delighted to see such a strong participation from central banks, regulators, and experts from around the world. Your continued engagement builds on the momentum of our first event in 2024 and reflects a growing recognition of the critical role that central banks play in addressing climate risk. The impacts of climate change are no longer distant threats. They are here affecting our economies, communities, and ecosystems. From extreme weather events to shifting agricultural patterns and rising financial instability, the risks are systemic, and it is urgent to identify, assess, and be able to address them. Central banks and regulators are uniquely positioned to help steer our economies towards resilience and sustainability. And I think this role is increasingly recognized by our different partners, and this is why this webinar matters. Climate scenario analysis and stress testing are not just technical exercises; they are essential tools for understanding vulnerabilities, guiding policy, and ensuring that financial systems are prepared for the future. They help us raise the right questions. What if? How exposed are we? What can we do now to mitigate risks and seize opportunities? At the EIB, hello, I'm not sure why I was muted. I'll just continue. Can you hear me?
Yes, we can hear you.
So I was saying at the EIB, we're committed to supporting this work. In 2024, we surpassed 100 billion euros in cumulative green and sustainability awareness bond issuance, and over 60% of our lending is now dedicated to climate action and environmental sustainability. But we know that finance alone is not enough, and we recognize in particular that regulation is key to make progress. In 2021, the EIB and the German government, through the EKI Fund, created the Greening Financial Systems Technical Assistance Program as a direct response to the NDC partnership's call for action that was the Readiness Support for Greening Central Banks initiative. It is a concrete example of how institutions can come together to turn ambition into action. So far, 20 central banks in 27 countries have joined the initiative by the NDC partnership, and EIB is proud to be one of the implementing partners contributing to its success. We need strong partnerships, we need credible data, and we need shared learning. So we're here today to make progress. This webinar is part of an effort to foster collaboration, exchange best practices, and build capacity. It is about learning from one another, whether you are just beginning your journey or already implementing advanced climate risk assessments. I would like to thank you for being part of this important conversation. Together, we can help ensure that financial systems are not only resilient to climate change, but also drivers of the transition to a more sustainable and equitable world. And I think it's particularly important to continue to build a coalition of the willing at a time when some doubt about the validity of this work. And that's also why we're here. So with that, I am pleased to officially open the event and invite our first speaker to begin this session.
Thank you very much, Isabel. Climate risk indeed pose new and complex challenges to the central banks, and we all look forward to the very interesting discussions amongst the presenters here today and our audience. Today's agenda brings an exciting mix of case studies from the two regulators who will share their experience in working on climate risk assessments, as well as some very interesting technical presentations that we hope will help all the central banks present in their ongoing and future work on climate risks. After each presentations, the audience will have 10 minutes to ask their questions to our presenters. Please feel free to open your mic and camera, state your name and organization, and engage. You can also use the Q&A box to drop your questions, where we will pick them up from. During the presentations, we request you to keep your cameras and microphones muted. Before we begin the presentation, as our custom from last year, if I could request all of you who are present to turn on their camera if possible for a moment for a group screenshot. One more second, please. Thank you very much. Now it's time for me to finally introduce our speaker for the first technical presentation, Ms. Tina Imambaksh from the European Central Bank. Tina is a financial stability expert at the Director General Macroprudential and the Financial Stability of the ECB. Her area of expertise lies in climate and systemic risk analysis and stress test modeling, particularly the transmission of climate risk to the real economy and financial system. Her work furthermore comprises the design and calibration of macroprudential policies for climate-related risks. She holds a double master's degree in economics from the Stockholm School of Economics and international economic policy from the Sciences Po Paris, as well as a bachelor's degree from Vienna University of Economics and Businesses. Tina, over to you.
Thank you very much, Anand, and hello also from my side. I hope you can see my screen, otherwise let me know. So I'm very
Yes.
happy to present to you today the first vintage of the NGFS short-term scenarios. And I'd like to start by bringing everyone on the same page of what the NGFS scenarios are and why we're doing this work. So the objective of the NGFS is to provide a shared understanding of future climate risks and the implications they have on the economy and financial system. And they explore a range of possible but also extreme outcomes to facilitate the cost-benefit analysis of transition costs versus the costs from natural disasters when temperatures rise unlimitedly. And then to also support the financial system to prepare themselves against potential losses and vulnerabilities. So that's why it's important to emphasize that these scenarios are not forecasts. We don't assign probabilities to them, but they're really the bookends, so the extremes of potential developments of climate change and transition risks. Now, the NGFS short-term scenarios fill a key gap in the current scenario framework, given that their focus is to the short and medium term, spanning at the moment until 2030. They integrate climate policies, weather events with economic and sectoral trends. And their time frame is particularly policy relevant, given that policymakers and also financial institutions base their decision making and strategies mostly within the next 3 to 5 years. They also have a much more detailed and granular information on financial and sectoral developments in a broad global coverage. And they also account for transmission channels of climate risk that are new compared to the NGFS long-term scenarios. So particularly the spillover of climate risk across international supply chains, specifically when it comes to the supply of minerals critical for the green transition. How are these short-term scenarios modeled? So here, quick word on the modeling framework. We have 3 models that are integrated with each other, each capturing a different part of the economy and financial system. The GEMI 3 model captures the macroeconomy, where we enter transition and physical risk as exogenous shocks. Then the carbon price from GEMI 3 is then fed into IRIN, which is the model that projects the inflation and the monetary policy rate of each scenario. And then we have ClimaCred, and ClimaCred is the financial risk model. So here the sector trajectories from GEMI 3 as well as the policy rate from IRIN is plugged in. And ClimaCred then models granular sector level, actually country sector level parameters for financial risks such as default rates and capital costs. And then in the last step, the capital costs from ClimaCred are fed again into GEMI 3 to then run what we call the integrated run, to then derive a final version of the scenario. So by integrating this 3 model, what is particularly the key advantage is that we capture also second round effects coming from the financial system back to the economy because of physical and transition risks. Then one of the key novelties in the short-term scenarios is the modeling of short-term physical risks. So different to the long-term scenarios, the approach taken here is a so-called storyline approach. So we assume that specific extreme and compounding weather events happen in specific years in the scenario. And then we capture the financial and economic implications of these risks. Two types of risks are modeled: dry events, which is a combination of droughts, heat waves, and wildfires. And the second event is the wet events, which is a combination of floods and storms. And the way these events affect the economy is through the channel of capital destruction, production loss, as well as labor and capital productivity losses. And also here, just to mention that the transmission of physical risk is really differentiated by different country sectors. So we can really distinguish how physical risk affects different sectors depending on their capital intensity. Now, what are the short-term scenarios that we model? We have 4 scenarios. 2 are transition risk scenarios. The highway to Paris is a scenario where we assume an early and coordinated implementation of policies that are aligned with a net zero economy. This therefore facilitates only a gradual increase in carbon prices, and the revenues from these prices are fully recycled back to the economy through green subsidies, which therefore also supports the economy in transitioning. Then we have the sudden wake-up call. Here we assume a business as usual scenario during the first 3 years. And then there is a sudden shift in the public opinion, and there is a sudden increase in the transition efforts. However, given that the transition happens later, a higher carbon price is needed, which also puts more stress and more costs on the economy to be able to really do the transition. Then we have 2 physical risk scenarios. The first is called the disasters and policy stagnation. And here we assume that the sequence of extreme weather events, so basically those that I explained previously, affect regions. And here we have actually multiple versions of this scenario. And in each version, it's a different continent where these extreme weather events hit. And then the other regions are only indirectly affected through trade and financial linkages. And then finally, the last scenario is the diverging realities. And here we have a combination of transition and physical risk. So we assume that advanced economies follow a highway to Paris scenario, but for the rest of the world, they cannot undergo the transition either because it's not feasible or it's too costly. And at the same time, we assume that those regions are affected by extreme weather events, which then spill over to advanced economies through trade linkages, and make the transition for them more costly because the supply of critical minerals is constrained that they would need for the successful transition. And before we go to the results, a quick word on the baseline scenario in the short term. So it's important to mention that the baseline here is different from the long-term scenario baseline in the NGFS. The macroeconomy in the baseline follows the IMF World Economic Outlook. And the baseline also is more plausible in the sense that it already incorporates a certain degree of climate risk. Specifically, we also account for the legislated and pledged climate targets of jurisdictions as of January 2023. So there's already a certain degree of transition risk. So if one wants to compare the short-term scenarios with the NGFS long-term scenarios, it's important to take into account that the baseline in the short term is actually the most comparable to the NDC scenario in the long term. So the one that is the nationally determined contribution scenario. And now going to the results and starting with the physical risk scenario, the disasters and policy stagnation. Here you see the evolution for the Asian continent in aggregate. And what we can see is that there is a sharp drop in GDP in Asia happening because of these extreme weather events. Here it's interesting to point out that Asia is actually mostly affected from wet events, so floods and storms, whereas the rest of the continents are actually stronger hit by dry events, as we can see in the upper right-hand chart. And so Asian GDP drops by up to 6.3% in 2027 because of the dry events happening in the previous year, followed by wet events in the same year. And then there's only a gradual and slow recovery. And as we can see, the recovery is not fully done by the end of the scenario horizon. Now, the destruction of these extreme weather events leads to a shortage in economic activity, therefore investments fall, and there is also a slower a reduction in demand for labor, therefore increasing unemployment. In terms of inflation, what we see is there is actually an initial increase in inflation, and this is because these destructions of because of these extreme weather events lead to a shortage in production goods, therefore making prices overall higher. However, this is quickly then followed by a deflationary phase because of the fall in demand and the reduction in economic activity. And then the last thing to point out is the chart in the lower right-hand side, which is the changes in default probabilities by sector. So this is really a novel element in the short-term scenarios, that we have sector-level breakdown of developments and also financial risk parameters. So what we can see here is that dry events affect mostly the agricultural sector, increasing their default probabilities. And for wet events, it's particularly the capital-intensive sectors that are affected. And what we can see is that for Asia, the increase in default probabilities is higher than compared to the world average. And what's also interesting to point out is that the power supply sector is actually the most affected by wet events. And at the same time, the power sector is a very important industry for the green transition. So this is also important to be kept in mind. Then continuing to the transition risk scenarios. In these charts, you see both the highway to Paris scenario as well as the sudden wake-up call scenario. And overall, what we observe is that transition risk, or the increase in carbon prices, what is modeled here, leads to a supply shock in the economy. So higher energy prices and leading therefore to to an increase in inflation, which then has negative effects for economic activity. We see a drop in GDP for the Asian economy, and this is much stronger in the sudden wake-up call scenario compared to highway to Paris. And this is mostly driven by the assumptions on the carbon revenue recycling. So in the highway to Paris scenario, we assume that carbon revenues are fully recycled back to the economy in form of green subsidies, which boost green investments, lead to higher employment in green sectors, and supporting overall economic activity. Whereas in the sudden wake-up call, the assumption is that carbon revenues are only partly recycled back, because some part of the revenues are actually used to support households and companies with higher energy prices. So there's a different distribution, therefore leading to higher costs of transition, because there's fewer subsidies available. So actually companies have to bear some of the costs by themselves, leading to overall higher costs and higher financial risk for these companies. So what we see in the lower right-hand chart is that there is an overall increase in default probabilities, particularly for high polluting sectors, and this is stronger in the sudden wake-up call scenario. We also see potential winners of the transition, however, only in the highway to Paris scenario. So here it is the green sectors or the renewable energy providers that actually see a reduction in their default probabilities, again, because they're supported by green subsidies, which boosts their overall performance. And then finally, the diverging reality scenario. So here, just to remember, this is a combination of both physical and transition risk. Emerging economies are affected by physical risk. So what we see here for Asia is similar patterns and dynamic as in the disasters and policy stagnation. Asia is first hit by a dry event in 2025 and then by a wet event in 2028, therefore leading again to a reduction in GDP, investments, and an increase in unemployment. And this spills over to advanced economies. So here what you see in the dashed lines is the change in the EU between highway to Paris and diverging realities. So in both scenarios, the EU is actually following a net zero scenario. However, it becomes much more costly and much more stressful for the EU in the diverging realities, because it relies on the supply of critical minerals from emerging economies, so particularly Asia. However, this is constrained in a diverging reality scenario, making it more expensive for the EU to import these goods and services, leading to higher costs. So overall, a reduction in overall investments and an increase in unemployment. So when we look at the lower left-hand bar, what we see is that in the highway to Paris, there is only a slight decrease in GDP for most regions. And in the EU, there's actually an increase in GDP because the highway to Paris is actually brings a net benefit for the EU. However, this is not the case anymore in the diverging realities. So in a scenario where some parts of the world are affected by extreme weather events, which has implications for other regions. Now I end my presentation here, and I'm happy to receive any questions. Thank you very much.
Thank you, Tina, for a very insightful presentation. I mean, as practitioners, it's great to see the work that has been going on in the short-term scenarios. And with that, the floor is now open to questions to our audience, if there are any. Yes, please go ahead, Shishika.
Good morning. Can you hear me?
Yes.
Yeah, thank you very much, Tina, for the presentation. It was really fantastic. Yeah, actually, I'm Jessica from the Agence Française de Développement. I was wondering what's your opinion as a practitioner on the quality of the scenario on some countries, emerging countries and developing countries. It has been criticized for a while, so I'm just wondering, yeah. Thank you.
Yeah, thank you very much for this question. And it's actually something that we also discuss internally a lot. So the challenge we face is that actually when it comes to the climate data, the coverage for emerging economies is quite good. So we would have the data necessary to model the climate risk of these countries. However, the bottleneck that we face is actually the economic and financial data. So we're really struggling for certain countries to obtain the required information at the necessary time span to be able to include them in the macroeconomic model. So that's why at the moment we don't have certain countries available because of this challenge. But just to say that for the long-term scenarios, what we're actually currently working on is the inclusion of additional countries, and the plan is to include a group of emerging economies that were not covered before in the new vintage of the long-term scenarios. However, for the short-term scenarios at the moment, this still has to be explored.
While we wait for the next question, Tina, and since we were talking about countries and the quality of data, I wanted to ask you if, like the long-term scenarios, the data for the short-term scenarios would be available and would be downscaled to country level?
So just to clarify that I understood the question, you mean that in the long-term scenarios, the information would be downscaled on a country level?
The question is like in the NGFS Data Explorer, in the long-term scenarios, there's regional models as well as some downscale models for at country level. Is there a plan to have a similar database at country level for the short-term scenario as well?
Yes, so this is actually already the case. So the short-term scenarios are already included in the EASA portal where you can explore the data, and you will have country-level information as well as regional, so continent-level information available. So whenever the country is not available, that usually means that we didn't have the necessary information or necessary data to model that country. And then one would have to rely on regional information.
Understood. And since we have several central banks in the room today, if a country central bank find that their data is not reflected in the portal, is there a way that they can engage with NGFS to facilitate the sharing of required data?
Yes, definitely. So if any institution would be available to provide us with economic and financial information of their data of their country, then we would be very happy to engage and explore whether we can include it. So they can definitely reach out to me or also the NGFS Secretariat, and we can talk about this. We would be very happy to increase our coverage as well.
Thank you very much, Tina, for the insightful presentations and the very clear answers. I think now it's time to move on to our next presentation.
Thank you very much.
Thank you. We have with us today as our next presenter Ms. Urgumal Sud Nanjid from the Central Bank of Mongolia, Bank of Mongolia. Ms. Urgumal is the head of Monetary Policy Division at the Bank of Mongolia. Her division oversees preparing monetary policy proposals and undertaking medium-term forecasts with policy alternative scenarios. In addition to formulating monetary policy, her team also develops macroeconomic, structural, and econometric models required for forecasting and policy analysis. Ms. Urgumal has been with the Bank of Mongolia for over 20 years, holding key positions in monetary policy analysis. For the past 5 years, she has also served as a secretary of the Monetary Policy Committee, editing and managing all communication tools, including statements and speeches to explain policy decisions. Prior to Bank of Mongolia, Ms. Urgumal also worked at the National Statistical Office and holds a MA in Economics from the University of Manchester and a Bachelor of Science in Economics from the Mongolian National University. Ms. Urgumal, over to you.
Thank you, Anand, for a kind introduction. My voice is okay?
Yes, we can hear you and we can see your screen as well.
Right, okay. So on behalf Bank of Mongolia, I would like to extend our sincere appreciation for invaluable support provided through the NDC partnership, which has enabled us to implement readiness support for greening central bank initiative since 2023. With this support, we conducted bottom-up climate scenario analysis in Mongolia in close collaboration with ESCAP. Today, I will share you the key findings and lessons learned from this assessment. Okay, let me. Okay, I will talk about the general view, objectives, and description of the main scenarios, then including transition risks and fiscal risks. Then I will talk about the qualitative risk assessment a little bit briefly. Finally, I will share what kind of lessons we have learned through this exercise. Let me firstly emphasize the global landscape of the climate scenario analysis in the financial sector. In 2022, the Financial Stability Board conducted 53 institutions across the 36 jurisdictions, showing a strong global momentum on climate scenario analysis. Since then, more central banks, including Georgia, New Zealand, Hong Kong, have launched or expanded their exercises. Globally, the number of regulators engaging in climate scenario analysis continues to grow, although many are still working toward completing their first exercise. Importantly, the Bank of Mongolia has become the first landlocking developing country to complete climate scenario analysis, which is a significant step in aligning financial oversight with the climate-related risks. However, this remains at an early stage in development of climate risk assessment. We are still in process of improving and piloting methodologies while continuing to build institutional capacity. Our assessment was carefully designed based on international best practices, particularly those used by regulators who had already completed their first climate risk analysis. As you can see from this chart, almost all regulators have assessed credit risks in the first phase. Majority have used static balance sheet approach, and almost all of them used the NGFS scenario along with the qualitative assessments. So these early pilots were not intended to be comprehensive from the start, rather than they were designed with clear objectives in mind to test methods, identify data needs, build foundational insights. Mongolia's exercise followed this same logic, setting stage for deeper and more refined assessments in the future. 2024 to 25 climate scenario analysis in Mongolia was developed with exploratory and investigative objectives rather than the regulatory aims. At this stage, we focus was on building fundamental understanding rather than the setting compliance standards. This first exercise was designed around 3 core objectives. First, to build capacity, both within the central bank and across the banking sector, to better understand and analyze the climate-related risks to the financial system. Second, to increase our understanding of the financial sector's potential exposures. These include identifying risks from climate events specific to Mongolia, as well as the transition risks linked to internal and external policy changes toward the low-carbon economy. Third, the exercise aimed to identify key data and methodological gaps, whether in climate data, financial data, or tools we use to estimate things like emissions, losses, or counterparty risks. This helps us to understand what is missing and what needs to be developed to support more robust analysis going forward. These objectives reflect a learning-oriented approach and lay the groundwork for more advanced and targeted climate risk assessments in the future. This slide illustrates 3 climate scenarios used in our analysis, taken from the NGFS framework. I believe most of you are familiar with these scenarios, but let me explain a little bit about in detail. The current policies scenario reflects a world where no additional climate action is taken. Fiscal risks rise significantly over time, with extreme weather affecting in the financial sector. The second one is below 2 degrees Celsius scenario, which represents an orderly transition. It assumes immediate and sustained climate action, which reduces fiscal risks and allows for smoother economic adjustment. Finally, delayed transition scenario shows that what happens if the policy actions are postponed until the end of the 2020s. it leads to sudden and disruptive shift, creating higher transition costs for financial institutions. This slide presents Mongolia's climate transition pathways and their economic implications of the selected scenarios. On the left-hand side, we can see that the strong climate action under the below 2 degrees Celsius scenarios lead to the steepest emission reductions, while current policies are not enough to meet the long climate goals. The late transition also reduces emissions, but at the higher future costs. In the middle, the carbon pricing is a key driver. Under ambitious or delayed transitions, carbon prices rise significantly, indicating the scale of structural changes needed to shift away from the carbon-intensive practices. On the right-hand side, we can see the macroeconomic impacts. Without stronger action, the GDP losses from the climate change deepen over time, while the early transition may bring some inflation and energy cost pressures. It ultimately stabilizes the economy, reduces the long-term risks. The message is very clear. Only proactive climate action is more cost-effective and better for economic resilience than the delay in transition. To incorporate the climate change impacts into the credit risk parameters, under the participating banks assessment, it was necessary to downscale macroeconomic variables into the Mongolian context from the NGFS calculations estimations. This process is very, very complex. So we sought guidance from the NGFS experts to support our effort. Then we finally successfully scaled down the macroeconomic variables from the NGFS estimations. The data was then further calibrated by the Bank of Mongolia to reflect the current national conditions, specific circumstances of the Mongolian economy. The banks were provided with the scenario-specific macroeconomic variables, including GDP, inflation, exchange rate, energy prices, etc. Using those variables, the banks estimated sector-level credit risk parameters such as probability of default, loss given default, expected credit loss under each scenario, climate scenario. This structured approach allows the financial institutions to better understand how climate risks may affect their portfolios and helps integrate climate considerations into credit risk assessment and credit management, risk management. Let me move to the next slide. Similar to the approach taken by the other central banks, also for the sake of this simplicity, one of our main key assumption is the use of static balance sheet approach. This assumption allows the Bank of Mongolia as well as the participating banks to isolate and understand the potential impacts of climate change scenarios on the current business models and balance sheets without interference from the other dynamic factors. So this slide shows how the climate change could increase the credit risks in Mongolia under 3 different policy scenarios. Starting with the ECL, we can see the highest increase of about 16% under the current policy scenario by 2050. This is a significant rise and translates into the additional loss of approximately 58 billion MNT compared to the below 2 degrees Celsius in the same year. Even under the more optimistic below 2 degrees Celsius scenario, ECL is expected to increase by nearly 12% relative to the baseline. So this tells us that the credit risk will rise meaningfully across all pathways, even with the strong climate actions. Next, look at the PD. We observed that under the 2050 calculations, PD increased by the 2.17 percentage points under the current policies, the 2.13 points under below 2 Celsius, and 2.26 under the delayed transition. These increases suggest that regardless of the policy path, default risk is expected to rise, with the delayed transition posing the highest PD risk. Similarly, the LGD increases most under current policy scenarios by about 3 percentage points in 2050, followed by the below 2 degrees Celsius delayed transition. While the differences here are smaller, but still point to elevated loss potential in the future. And as a summary, these findings reinforce the importance of the integrated climate risk into the credit risk assessments. Even under optimal climate scenarios, financial losses are expected to increase significantly, and cost of inaction or delay could be substantial for Mongolian financial system. This slide outlines how climate shocks, specifically more chronic acute fiscal hazards, translate into the credit risks in Mongolia's financial system through the both fiscal transition risk channels. So on the left-hand side, we see the fiscal risk drivers, such as floods, droughts, and other chronic climate events. Those events directly affect the households, businesses, public sector, reduced income, rising costs, asset devaluation impact their ability to repay loans, increasing risk defaults. For banks, this leads to higher non-performing loans, increased provisioning, and lower equity ratios. In parallel, the macroeconomic transmission channels component these risks. Climate-related shocks raise government debt, disrupt labor markets, reduce economic productivity, as earlier mentioned by the NGFS slides. Over time, this weakens the economic growth, raises borrowing costs, putting the further pressure on the financial system. On the right-hand side, we have transition risk drivers rising from the policy shifts such as carbon taxes or technological changes. This can lead to stranded assets, especially in carbon-intensive sectors, and increase the business costs, litigation risks, investment uncertainty. At the macro level, these transition risks can reduce GDP, constrained by government budgets, weaken the credit ratings. As a summary, impact of the drought is not only environmental, but also the deeply financial implications. In this slide, I would like to highlight the key climate risks specific to Mongolia. the compounded impact of zoot drought on our economy and financial system. The zoot refers to the extreme weather condition, such as deep snow, intense cold, heavy winds that limit access to pasture and often cause mass livestock deaths. In a country where livestock underpins rural livelihoods, these events have severe consequences in both economically and as well socially. The risk intensifies when zoot coincides with the drought. For instance, the Gobi region livestock mortality during the years with both hazards averages 18%, significantly higher than when either event occurs alone. This highlights the importance of assessing compound risks, not just isolated events. To reflect this, we developed adverse scenarios for 2030, 2050 based on years where zoot and drought occur together. These are grounded in projections from National Agency for Meteorology and Environment Monitoring Mongolia under the RCP 8.5 pathway, supported by the historical data and the literature. The understanding these compound risks is essential for building financial system resilience and guiding effective climate risk disclosures and policy responses. We quantified the impact of zoot and drought shocks using data from the Climate Impact Explorer of the NGFS. Due to the projected increase in winter snowfall between December to February by 5 to 35% by 2030 and 10 to 45% by 2050. Number of livestock losses is expected to rise significantly, reaching 11.5 million by 2030 and 15.5 million by 2050. Those are our main estimation, best founded estimations quantified by those shocks. Then we estimated the economic impact of zoot drought shocks as a percentage of GDP. Unsurprisingly, the agriculture sector is most vulnerable, experiencing significant negative effects on economic growth, while other sectors are relatively less affected. This slide illustrates the impact of zoot drought shocks scenarios on credit risks. The results are as follows. Starting with the expected credit loss is increases by 11.7% compared to the baseline in 2030, amounting to the around 76 million USD. By 2050, ECL nearly doubles, rising by 22.7%, reaching 522 million MNT. It's around 150 million USD. Similarly, the probability default increases by 1.4% in 2030 and by 1.5% in 2050. These results highlight significant impact of zoot and drought shocks on loan quality and credit risk within the banking sector. Okay, let me move to the next fiscal scenario description. Mongolia is home to over 4,000 rivers flowing through the three major basins: Northern Arctic, Pacific Ocean, Central Asian internal basins. These rivers, lakes are vital sources of fresh water for the country. However, due to the Mongolia's unique geography, we face increasing risks of flooding, whether from rivers, snow melt, or sudden flash floods, especially between May and August. Importantly, flood events have become more frequent, while only 10 major floods occurred between 1900 and 1950. The same number has already have been recorded since 1970. This highlights the growing pressure from the climate change or urgent need for stronger flood resilience. As part of our climate risk assessment, the banks applied defined price shocks to the residential and commercial properties across different flood risk zones in their credit risk evaluations. This is a key step, as the impact of flooding on property values, especially in Mongolia, remains understudied due to the limited data and data availability. We used baseline figures from the ECB's climate stress test and adjusted them using studies from the countries with richer data sets, such as Malaysia, Thailand, China, and the US. These are not forecasts, but informed assumptions to help estimate the mortgage market exposure, pilot methodology for assessing credit risks from the fiscal climate hazards. Ultimately, this work supports stronger data systems, capacity building, and greater financial sector resilience to the climate shock. We asked banks to assess their mortgage and real estate backed loan exposure using a three-step process. First, they mapped all such loans by geographical locations or zone level to identify exposure to the flood risks. Secondly, they reported loan data by a flood risk zone, including number of loans outstanding, amounts, LTD ratio, provisions, LGD, ECL risk parameters. Step 3 requires banks to recalculate key risk indicators by applying the defined price shock to property values. They adjust LTV ratios, provisions, LGD, ECL to reflect climate-related declines in real estate value. This helps assess how fiscal risks like flooding could impact loan quality. So this slide shows the main results of the flood scenario. For very high flood risk zones, expected credit losses increased by about 14%, or 140 billion MNT. In high risk zones, it rises about 8%, or about 2.6 billion MNT. Similarly, the loan provisions rise by 15% in very high risk zones and 10% in high risk zones. These shifts highlight how climate risk shocks like flood can significantly impact the banking sector banking sector financial conditions. Also, we asked participating banks to estimate the financial emissions, but we all know that in most countries, including the Mongolia, the counterparty level information on financials and emissions is very limited, not available. So it's a very hard task for the participating banks. But of course, we asked them to counterparty level financial or emission data is unavailable. Please, banks should use to follow the guidance on in the PCAP, Global NGF GHG accounting reporting standard for financial sector. But unfortunately, the PCAP guideline is very comprehensive and very complex. So they are very has a lot of challenges to follow the PCAP guideline. So we asked some assistance from some international organizations to more simplified approach, simplified methodologies to estimate the GHG emission in Mongolian case. So it was very helpful for the commercial participated bank. So these are the main results. I think we get these few numbers and aggregated level, but it's really hard job for the both central bank as well as the participating banks. So if you look at the main results, the bank financed emission make up only 23% of national emissions, suggesting key emission sectors are also funded by non-bank sources. It could be external, like FDI, or it could be like public sector financing, or it could be like non-bank financial institutions. The participating banks show the highest financed emissions in agriculture, reflecting national trends. The mining and electricity have lower financed emissions, likely due to the state funding or FDI highlighting transition risks for public and foreign investors. The banks finance around 50% of transport and 40% of manufacturing emissions, making these sectors potential priorities to decarbonization. Okay, lastly, in addition to the quantitative assessment, we conducted qualitative assessment for to gather further insights of banks' governance and internal practices of sustainable finance and green products. So we designed the quite similar structure of the questionnaires. The questionnaires contains as following the structure, like we asked about general climate assessment overview and asking what kind of challenges are you facing in regarding climate related data availability and methodologies, and additional details on scenario analysis, as well as the qualitative assessment of other climate related financial risks. Because in our first in this assessment, we only focused on the credit risks, but beside credit risks, there is a liquidity risk, operational risk, and legal risk. So we're asking about other risks. What's the bank's concern about other risks and future plans regarding the climate risk stress test? Lastly, using how are the banks are going to use the result of the climate stress scenario analysis in the future. Finally, finally, what kind of lessons learned and the key steps for the next key steps. So as part of this climate risk assessment, we have employed a variety of modeling techniques to estimate key risk parameters, including FIDI, LGD, ECL, and the approaches vary across institutions, reflecting differences in modeling capacity, data availability, and internal risk frameworks. It's also important to recognize that banks' exposure to climate risk differ significantly depending on their business models and sectoral focus. This underscores the need for tailored approach, one that allows each institution to identify and prioritize its most material climate-related risks. We have also observed varying degrees of integration of microfinancial variables in the modeling process. Some banks have made more progress than others in linking climate risk to financial drivers, which is promising sign as we move forward more refined methodologies. While the results at this stage represent preliminary estimates, they are nonetheless critical milestone. They offer valuable starting points, reflect encouraging level of engagement and analytical progress across the banking sector. Looking ahead, the Bank of Mongolia intends to work closely with each participating bank to review these outcomes, identify any methodological gaps, jointly develop capacity building and implementation plans. This collaborative process will be essential as we move toward integrating climate risk more systemically into the financial supervision and risk management. Looking ahead, there are several important steps that banks are encouraged to take as we continue to strengthen climate risk management across the financial sector. Firstly, banks are expected to continue working closely with their counterparties to improve both data collection and data quality. Robust and granular data will be very, very essential for producing reliable and meaningful results in the future iterations of the climate risk analysis. Secondly, it's very important for banks to revisit, enhance their credit risk models. In particular, models should design to incorporate forward-looking variables that may significantly affect credit risk in changing climate change, many of which may not yet have strong historical data. This requires a shift in mindset for traditional risk modeling to more scenario-based or dynamic approaches. To support this transition, Bank of Mongolia recommends that banks invest in internal capacity building. Credit risk teams should be equipped with the necessary skills, tools to develop and apply climate risk models. This includes training, methodological development, cross-functional collaboration within the institutions. Finally, the banks are encouraged to continue testing their portfolios for climate-related risks as part of their voluntary disclosures and internal risk assessment frameworks. The Bank of Mongolia will monitor these efforts through the regular climate and ESG reporting. Okay, finally, the next steps I would like to mention. The Bank Mongolia held one-on-one sessions with each participating bank to review the individual results, identify key areas for improvement. As the next step, Bank Mongolia will conducts the top-down climate assessment to complement with the bottom-up analysis. This approach will help address challenges related to the data quality and availability while enhancing the use of cooperative analysis to better inform policy decision-making. To raise awareness across the broader financial system, Bank Mongolia also plans to launch e-learning courses focused on climate risks. Okay, I think that's the end of my presentation. Thank you for your kind attention.
Thank you very much, Ms. Urgmal, for a detailed and comprehensive presentation. It's really inspiring to see the strides that Bank of Mongolia has made in this topic. In the interest of time, we will request the audience to leave the questions for Ms. Urgmal in the Q&A section, or we'll circle back towards the end of the presentation. For now, I would like to invite our next speaker. Our next speaker is Ms. Jijika Kashinura, who has nearly 20 years of experience in finance, spanning both market finance and development finance. She began her career in asset management HSBC Allianz before moving to the African Development Bank, where she managed infrastructure financing, including energy projects. Since 2018 at Agence Française de Développement, she had led public policy dialogues on ecological transitions in countries like Indonesia, Colombia, and Ghana, and conducted research on integrating sustainability into financial system. Her work critically examines key sustainable finance tools through the lens of double materiality and socio-environmental accounting. Ms. Kashinura, over to you.
Yeah, thank you very much. I'm trying to share my screen, but I don't know. I'm struggling to do so. Yeah, I'm very sorry for that. But actually, I have just 2 slides, but it's not coming. I'm sorry. Is there a way to? Yeah. Is there a way to arrange that?
If you could
Or
please
maybe
set
I
us the
can.
presentation.
Yeah, very quickly. Yeah. I'm sorry for everyone, and then I just send the email, and then I will start the discussion. Okay, here we are. Okay.
Meanwhile, we are setting this
Okay.
up. If there are any questions for our
It's
previous
there.
speaker, please
Okay.
go ahead.
So I will make some introduction on. We have been. So we are. I'm sitting at Agence Française de Développement, which is the bilateral development agency of France. And so the experience I will share just through 2 slides, I think I will take not more than 10 minutes, is about our experience as a provider of technical assistance for regulators and central banks, both on the, I would say, on the assessment of microfinancial risk and the assessment of more like idiosyncratic risk at the institutions level, regulated institution level, financial institutions. So I would like really to make sure that because there is sometimes confusion on financial risk, climate financial risk, climate risk, climate microfinancial risk. So I think it's important to remind what we are, what's the design of each of it, and how it's. I think it's different from a country to another. And yeah, thank you very much for the slides. So we can switch to the next slide. Yeah, thank you very much. So yes, first, this is actually a figure coming from our policy paper that we have recently published. It's already last year, actually, on the design of climate financial policies on the stance of emerging and developing countries we are partnering with. And we have realized that there has been, like after the Paris Agreement, from the 2018 and the TCFD coming in and the NGFS, a very like a rush toward implementing tools, implementing financial regulation, which is mainly based actually for now on disclosure. And we have been discussing with colleagues and other central banks that we are working with and financial institutions, and where we realized that there is really a rush on that. And mainly actually, as Europe was one of the leaders on this matter and developed countries, sorry. So we're asking ourselves, why should we implement all together with our partners the same like regulatory frameworks, kind of stress tests, kind of idiosyncratic risk assessment, etc. So before, in our policy dialogue, for example, we really start on asking the question, what is the purpose and the theory of change behind all these implemented tools and regulation? I think it's really important, because behind that there is sometimes a waste of time, a waste of means, a waste of money, and perhaps there is we are losing kind of political capital there, and saying, okay, what do you want to achieve? That you ask that to do this, and this, and at the end of the day, how to achieve all this transition, ecological transition agenda. So first, on the policy implementation, we really rely at AFD at least on financial regulation as part of the global policy regulation, and it cannot be taken away and just have a theory of change on financial system. So this is really important, even if we stress absolutely we are with central banks, the key mandate and agenda of central banks, which is financial and monetary stability. So this is the basic of this pyramid, which is number one, which is micro and micro prudential regulation. And we have seen really many regulation coming through Pillar 3, which is about disclosure. But disclosure really needs to be also useful to understand the risks there. And as mentioned by, I'm sorry, I think it was Tina, I'm maybe mistaken with your name, on transmission channels, which are really different from an economy which is very diversified, an economy which is not diversified, an economy which is more sensitive, exposed to external shocks and external risks. So the story is really different behind this. So for example, on transition risk, we are really, actually, we are not we have been very reluctant to use this kind of simple transition risk proxies, which is emissions, because what we realized is that sometimes financial regulators, they don't even ask themselves what is the accounting behind this, what is the carbon accounting behind this, because it's not neutral at all. So you need really to ask yourself about first carbon accounting behind this, the risk drivers, which are external and or domestic driven, which is on at all, it's not the same story whether the risks are driven by from external or domestic. Furthermore, we stress the fact that we don't support, for example, the PCAF methodology on financed emissions, and especially for transitioning activities, for example. And financed emission is really like on the macro level, taking it as carbon pricing, maybe it can make sense. But at the end of the day, at a corporate level or an institution level, transition risk is just about market risk. This is just about supply and demand curves. It's about competition and supply and demand curves. actually in Europe, one of the main, for example, this is an example that I give. I don't know whether you will classify it as transition risk. Is the battery factory which went down, hydrogen also, for example, and this is all green technologies. We are not advocating for at all to not invest in green technologies, but really it's really important to understand that it's a very blind way of doing things, just taking it as a proxy of emissions without even knowing what is the carbon accounting behind that. So this is my first point. This is why we support addressing transition risk at the macrofinancial level, which makes a lot of sense, especially in some of our countries we are working with because of their dependencies, which is on fossil related revenues. And for example, on the banking sector, the risk would arise not really on kind of transition risks as we investing in a fossil fuel company, for example, but mainly from the exposure to sovereign risk. So this is, for example, a transmission channel that is addressed in some methodologies, but not in the right way as we see it in many methodologies. And what we don't control is the external transition, the domestic transition. Actually, if we are isolated from external markets, so it's not a risk there. So this takes me to the second point about alignment policies, because since 2015 and the Marc Carnet speech, I think there is a lot of many practitioners which were confusing risk management, which is the key. I fully agree that this is the key mandate of central bankers, and the transition. This is not because I'm managing my risk that I'm financing transition and vice versa. So I think it's really important to distinguish the two objectives, and saying that dealing with transition risk will take us to transition. It's not true. It's partly true, but not fully true. And there is many reasons, even like some cognitive economics about mind shifts, etc., and the endogeneity of the financial sector. So on the alignment policies, we really advocate for working with transition planning. The taxonomy design is very I think is also, for example, sometimes misunderstood on the purpose of taxonomies. And while taxonomy are like static process telling us what is green, but it doesn't tell how to do that. So this is why we also advocate for like transition planning and thinking about the interactions and the dependencies of a transition with policies, etc. So it's not just like, okay, you have your taxonomy, so the whole economy will be greener. So it's more like a policy dialogue. Having investors, actually, they want certainty, they want visibility, they want policy implementation. And if you set a taxonomy without telling what's the theory of change behind it, how to use it, what's the purpose of it, it just end up like a compliance exercise. So we don't want things to be a compliance exercise and to lose our political capital on inefficient tools, even if well designed. They are all interesting tools there. So my point is that it's really important to be selective on many tools that have been developed, which are really great, and to understand why should I use stress tests, what are the limitations, what is to have a discussion about about scenarios, because as mentioned by Tina, also scenario as just a plausible pathway. Sometimes we have seen some implementation of blind to the scenario, but the most important and the most interesting part of scenario design and stress test exercise is to discuss the scenario, is to discuss the assumptions, and this part of the exercise is really key important. And coming back to the second point on alignment policies, I would like I think I don't have much of time remaining to stress out the adaptation and the physical risk issue. And this is really something that we need to address at macro-financial level, at micro-financial level, at meso level, and we really advocate for capacity building on this part of the exercise. And it's really important to have everyone involved, corporate, non-financial institutions, financial institutions, regulator, and to have a deep dialogue on that, and to be backed by science, because you cannot also just give scenarios to a banker and or even to even for an investment banker and say, hey, you have here the scenario, so just run your exercise, or because adaptation and physical risk is about exposure, understanding vulnerabilities, understanding the hazards, understanding the uncertainty around it. So all those things are really, what we don't want to see is, don't take these exercises as compliance exercises, etc. Really to implement them and to in an efficient way. And then I will come to my last point, which is about monetary and credit credit alignment allocation policies, which are more like present in some countries rather than others, but it depends actually on the mandate of some central banks, which are mandated to support, to explicitly support economic growth, etc. So, but these are interesting policies that need to be considered, like is in China and in India, in Bangladesh as well, I think. So we really advocate also to think about this last point, which is about credit allocation policies. And then next slide, I will, just 1 minute for this slide, which is about the fact that we are advocating for a contextual approach, meaning that depending on the financial complexity of a partner country, depending on their exposure to external transition risk, to domestic transition risk, to physical risks, we will not have the same policy dialogue there, and will not implement the same technical assistance and dialogue. And one last point, what we observe is that risk, the first way to manage risk is to avoid risk. So risk avoidance can mean, even if transition or adaptation, meaning that it means exclusion, financial exclusion. So this is a very it's central in our dialogue about how to deal with that, because you exclude the most vulnerable, you get away the vulnerable SMEs, people on the retail banking and corporate banking as well. So you really need to think about what are the right incentives and policy, monetary policy, like credit lines dedicated to that, or blended finance with de-risking from public finance on those issues. So we separate, we have like a 4 classifications based on all these items. And then last slide. Thank you. This is to come back to the first, my opening point, which was about, okay, we have developed a lot of tools, we have methodologies, mainly from developed countries, perspective, and from private-led initiatives, which are really good, and I will really support that. For example, from CDP, from coalitions, etc., from net banking, from GFANS, from all those alliances, which are really good, but it just translates one point of view and not a certain point of view from a geographical point of view, which is mainly dominated from developing countries. Developed countries, sorry, and the other bias there is that it's private sector led, so which is normal. So it translates the way the private sector is looking at the thing. So it needs to be like more co-constructed process, and from public regulators as well would like to see public regulators to be more like proactive rather than reactive on all those issues, and especially on physical and adaptation, which physical risk and adaptation. Thank you very much.
Thank you very much, Ms. Kashur, and especially for the excellent time management. In the interest of time, I would request our audience to drop the questions in the chat or in the Q&A, and we hope to circle back to our speakers after all the presentations to do another Q&A sessions. For now, I would like to invite our next speaker. Our next speaker is Mr. Ashwat Petrosyan, who currently serves as the head of financial sector development at the Central Bank of Armenia. He's also a lecturer at the French University in Armenia. In the past, he has held various positions in the central bank, as well as a survey expert, analysis division, head of economic statistics and development divisions. He completed a certificate program in finance and economics at the Fletcher School at Tufts University, prior to which he obtained a PhD in finance and money from the Institute of Management and Economic Reforms in 2005. His undergraduate education was at the Economic University of Armenia, where he also attained a master's in macroeconomics in 2003. Mr. Ashwat, the floor is yours.
Hi, dear colleagues. Can you see the presentation?
Yes, we can see you, the presentation, and hear you clearly. Thank you.
Okay, thank you very much. So it's my pleasure to be here, and it's my pleasure to speak on behalf of the Central Bank. And first of all, of course, I want to say big thanks to the program, to EIB team for a great job we did together in order to create what we have for now. And the main topic is about the climate risk navigator. Before going deeper into the navigator, I just want to remind that the navigator is done along the central bank's sustainable finance roadmap, because recently, almost 2 years ago, in October 2023, we adopted our first sustainable finance roadmap. And based on the roadmap, the main idea is to provide a strategic framework for integrating ESG consideration into the financial sector. It's really very ambitious roadmap, because somehow Armenia was a little bit back to the international achievements by that time, and in order to catch the time, we just had to have the roadmap as ambitious as it could be. And based on this roadmap, we have one big part. It's about reporting, it's about disclosure, and we think that this part is one of the most important, because it aims to ensure that our market is transparent, that we have very good market discipline in the financial sector. The idea is to, of course, work on banking sector capacity to identify, to assess, to manage ESG and climate risks, to raise the awareness of the sector against all these kind of risks. And so, based on all these ideas and all these purposes, recently, almost 1 month ago, we finally adopted our reporting and disclosure framework, and now we sent it already to our commercial banks, so they are going to make the first reports by September this year. We think that this is a very big step. And having this and also having the need to create a tool which will help our banks to manage their climate and ESG risks. So kind of we have these two targets, and I guess the navigator tool that we are talking about today is a very best how to say synergy of these two tools, of these two targets. And having all the preconditions, the precondition is mostly about data challenges, because I guess it will not be a surprise that in Armenia we have very big data lack. And for example, many banks, they don't have necessary information. They don't have emission data, they don't have climate exposure data, they don't even know in some cases the exact geographical location of assets. In maybe some during the lending period, they just have the overall understanding in which region is the asset, but mostly even don't know the exact location of it. Of course, the asset level or regional level is very high granularity, so low granularity. So we need to have more granular data, but unfortunately we don't have it. Lots of problems with the data standardization, because in some cases, yes, the data is there, but it's still information and not data. So it's not systemized, it's not structured, so it's not standardized, and in some cases, banks cannot use it, And many times, in many cases, because they don't have their own data, they need to use some proxies. So we have kind of all these preconditions, and we have these two main targets from the sustainable finance roadmap. And so based on all this, we came to this climate risk navigator. And this tool really will help us, and it's already live, because the team presented this tool to the banks and they are familiar with it. So what we have, first of all, we have data integration on the level that is more or less comparable to what we have in our financial sector. Means we have the our own data, which is somehow reorganized, structured. We have some, as I told, we need to have some proxies. So in these cases, we use some internationally well-recognized proxies. About the regional customization, we try to use all the regional levels that is possible to have. And we also took the activities based on NACE sectors, because again, with the NACE sector, it's another big problem. We have some data that is not based on NACE, but based on some other classifications. And in many cases, the classifications are totally different, and they are not somehow comparable with NACE or with other international recognized classification systems. We used the scenarios that are very well known, NGFS scenarios, IPCC scenarios, and we used 3 time horizons, 2030, 2014, 2015. The result is that we try to really map, really measure the physical and transition risks. Skipping the theoretical part, I'm sure we are all familiar with it, how the physical and transition risks affect the business, affect the financial sector. But telling about the theoretical, about the overall influence is one thing, but here we really tried to somehow calculate and give some numeric assessments, calculate the exposures and so on. So there is the climate risk navigator, as I already told, it's a tool that will help the financial institutions to identify, assess, manage climate-related risks, and also will help us as a central bank, as a regulator, to understand the risk exposure, to understand the vulnerability of the financial sector, the financial stability risks if there are, and maybe make some actions to guide the financial system to a more low carbon economy and so on. And with the physical risk mapper, I like this part very much because it really gives us a very good first time in the history. It gave us the opportunity to measure the risks, because we all know that the risks are already there. And what is the most important with this type of projects, that this help us to say and calculate that the risks with the climate change, they are already here. Now, these risks are not about like 10 years, 20 years horizon, 30 years horizon, but most of them are already here. Here, what we have, first of all, we tried to fix the data on municipality level. In Armenia, we have 81 municipal units. And we have, as a final result, we will see in next slides, we have the assessment of each climate risk in all these 81 municipality levels. And also we fixed what kind of climate hazards we need to evaluate, because of course there are lots of climate hazards, but not all of them are particularly for Armenia, because we have one kind of hazards and don't have something else. So for this moment, we fixed 6 hazards. This is heat wave, drought, extreme precipitations, floods, wildfire, and landslide. Geographical level, the risk types, the scenarios that we use. These are the 3 well-known scenarios: 126, 245, and 585. And also, as I told, 3 horizons. In the table, this is kind of an example. You can see that what we have the municipality name. We have the climate risk, which is floods. We have scenario 585, and we have 2040, the year. And we can see for each scenario, for each municipality, and for each type of climate risk, we will see the result, how probable is this or that risk. In this case, the flood in this special municipality is very low probable, so the risk score is only 1. The risk level is from 1 to 5. 5 is very high and 1 is very low. And as a final picture, we can see here that what we have here, 5 categories of risks, very low, which means that no immediate action required. So the bank can even don't pay any attention to this type of risk. The low is it's already that you need to do some minimal actions, and of course we have very high, which means that bank need to start worry about it, need to make some actions and so on. And as I told, for all type of these 6 risks, you can see how probable, how risky is the municipality, the regional part of Armenia. For example, based on this analysis, we can say that extreme precipitation hazard is not that big problem for Armenia, because we don't have high risk in neither of our region. In a couple of them, we have some moderate risks, which can be very well managed by the bank. So we don't need to care that much about the extreme precipitation, but what we need to care, it's more about heat stress, and it's more about landslides and all other risks, the floods and droughts, again a little bit less the wildfires and so on. And how the banks can use it, of course they can quantify the exposure. This is the best solution to quantifying the possible exposure. and then can apply also this kind of collateral haircuts. For example, if your collateral is in a region where you have very high landslide risk, then I don't know, I use some 80% haircut or 90% haircut of some other percents. First of all, the most important thing, I guess, we don't make this navigator mandatory for use for banks. They can use it, they can use something else if they have some better solution based on their opinion. But what is very critical, we need to be sure that all our banks, they really understand, they really manage the climate risk. Why I'm putting stress, because in some cases we usually get lots of questions of, okay, for example, if the bank understands the high risk of landslides, what they need to do. There is two ways. First, to give the banks the exact tools to mandate them to do some actions, but we so far we didn't use this way, we didn't choose this way, but we told them that our main target is to be sure that you really understand the risk, that you really evaluate the risk, but quantify the exposure and so on. But your actions will be really your actions based on your policy, your risk appetite, and so on. Again, here we can see the same picture, but with the three different horizons, and for each horizon we can see the probability, the how to say, how intensive is this or that risk exposure in based for this or that climate hazard. The real usage of this physical risk mapper. The first one is, of course, the risk management, as I already told, because we really want them to make their credit risk assessment, to review the thresholds, to do maybe some internal rating models, and incorporate this kind of risks in their internal internal rating models, and so on. The second biggest usage is, of course, the disclosure. And this tool is very good in order to organize the disclosure, because, as I told, here we tried to take, for example, that level of granularity that is understandable and acceptable by the banks. Because we could go to more granularity and do the analysis not for 81 regions, but go even deeper. But there is no use, because banks don't have that granular understanding of the locations. So for climate-related disclosures, this will help us to quantify the exposures, to calculate these Pillar 3 climate risk exposures, CO emissions, and so on. Of course, also this type of tools, this is very, very important, and we are really very thankful that for this point we had very good, how to say, communication with our banks, because these tools will also help them to create very good client advisory process with their potential clients. So when bank understand that they have high exposure on some exact risks from some exact regions and so on, they can start a process, they can support their clients in identifying adaptation needs, for example, what they need to do in order to manage the drought risks, for example, investing in irrigation, investing in some other technologies. This will make more effective to promote the adaptation finance to the banks and so on. And as a final result, I hope that using all these tools will help us to develop new financial products, to do some proactive steps in order to be sure that our financial system is going to be greener and greener. What about transition risks? Again, a little bit theoretical part is here. The risk factors are the direct cost of emissions, indirect cost of emissions. And for example, if we start to have some carbon prices, carbon taxes in Armenia, we don't have a carbon tax so far, but the risk that we will have carbon tax, of course, is very high. And also all these transition risks, they are also about the increase in capex investment, the possible decrease in revenues, and so on. Again, based on this tool, we could somehow calculate the exposure, the risk level, and for example, based on this analysis, we realized in some sectors of Armenian economy, for example, in mining, in agriculture, in electricity, transportation, we have very big probability, very big exposure on transition risks. Then they mostly start from 2040. And this is also, as I told, very good that maybe we knew all this even before the tool, but the tool gave us a really nice opportunity to measure and to have some numeric calculation. And so this is really very, very important. So how they are going to use the transition risk mapper? In some cases, this is the same way as with the physical one. But here, they first of all, they need to track the exposure to sectors and inform again the potential clients about the potential red flags and maybe some other how to say actions that will help their cooperation with the commercial banks. Again, here is the same client advisory, because here also the banks can do great job in order to help the real sector to be more adaptive against these climate risks. And again, as a final outcome, we will have more green and adaptive finance lending and financial system. Overall, as I already told, this tool, this is a very great opportunity to start. First of all, it's in a very right time, because as I told, like 1 month ago, we disseminated the reporting standard, the reporting framework, and the banks already with this tool, they also get some tool how they can do this reporting. So again, thanks a lot. I guess this is all that I want to tell. Thank you.
Thank you very much, Mr. Ashod. May I quickly ask if there's a quick question for our presenter? And if not, we will always circle back towards the end of the session if there are any questions for all of our presenters. I think now it's time to move on to our next presentation. Our next presenter for today is Mr. Igor Mastin, the professor of economics at the University of Ljubljana and the founder of Econ Lab, a renowned expert in the areas of risk management, banking, econometrics, finance, and macroeconomics. Both academically and professionally, he specializes in financial risks, asset pricing, quantitative risk management, and economic modeling and intelligence. Before founding Econ Lab, he was a partner in charge of financial advisory services at Grant Thornton Advisory in Slovenia. He has also worked for the central bank as head of research, and in his capacity supervised the Department of Central Bank stress testing and economic modeling. With that, Igor, I hand it over to you.
Thank you, and a very good day to all of you. Let me try to set up the screen. So do you see this?
Yes, we
Can you
can
hear
see
me
your
okay?
screen and hear you okay.
Thank you. So what I'll present is a case study, and so like I will motivate it. So where do we land, let's say, in our modeling endeavors? So if one would look at the very like generic say key elements of one needs to look at in assessing climate risk modeling principles, is we see that you know there's identification, there's data collection, then we need to somehow put some economic value, so essentially economic evaluation of translation of say events into monetary units. Then we need to combine those with scenarios. There's been a heavy discussion in each of these events on how do we select scenarios? What are the most appropriate? Let's say the first paper today was extremely beneficial because we were continuously struggling with say the area of transition risk, translating risks that were until recently available in terms of projections for very long horizons into a short-term horizon. But what is ultimately, the end goal of it is, how do we integrate, any measure of risk, however precise or imprecise it is, into risk model. And this is what, is, let's say, the primary objective of the case study that I'm going to present today, because it influences say many levels of decision making when it comes to RING, both at public institutions such as central banks and commercial institutions. So the framework that I'm going to graphically present here is, let me try to minimize this if I can somehow. Yeah, I'd minimize this. So I hope you are seeing this better than I do. So it's applicable essentially to any type of risk, and it is applicable to say climate stress testing or climate risk assessment in public institutions and commercial institutions. So we've been applying the framework for climate stress testing in central banks. At these events, I presented the case study of an exercise that we did for the Central Bank of Georgia. Then we integrated the framework into a sovereign rating model at a multinational development bank, and also to a couple of commercial institutions that wanted to have the risk assessment conducted at the level of bank's obligor, a client, so to speak. And it goes in 4 steps, again, depending on the level of application. So first, one needs to choose a scenario, and either working with physical or transition. Then, depending on the horizon, it all comes down to again, depending on the resources that one has, because climate risk is inherently sectorial, so it's sector specific. We need to somehow translate macroeconomic impacts into something that I call GVA shocks, so gross value added shocks at the sectoral level. So in absence of very granular data, so the previous speaker was describing how financial institutions are facing challenges in data collection at the borrower level. At least at the sectorial level, our experience tells us that using input-output methodology, in many instances publicly available, we can get very, very accurate approximations, both in terms of gross value added shocks, but also in terms of estimation of susceptibility to transition risk, so CO2 intensities, and for that reason also CO2 related costs. So then one moves to modeling risk parameters. So here this is at the bottom of these graphics here. We are trying to be specific about physical risk, because this is what I'm going to talk about the most today, but it would equally apply also to transition risk, in the sense that the main difference is actually that in relation to transition risk, one needs to have a model that would allocate CO2 related costs at a certain level. Normally this is at sector level, and then one needs to basically once this economic let's say impacts at sectorial level are obtained, one needs to translate that into PD or LGD models. So these are typically at portfolio level, or even if we're talking at the central bank application, it would be even at an aggregate level. Ideally, one would not treat climate risk here separately than from the normal credit risk assessment. So it's preferable that be it a public institution or a commercial institution would be using their own methodology in which climate risk would be integrated into. And then once we have those, let's say, projections, it's about the level of disaggregation that we want to choose. Public institutions would typically evaluate at a more aggregate level, so sectorial level, looking into GVA shocks. Again, that is universally applicable to both physical and transition risk. Or, what we do ultimately in certain commercial institutions, we want to bring and evaluate the impact of climate risk on individual borrower financial position. So, model things like leverage ratios, debt to EBITDA ratios, growth of sales, cost efficiency, so profitability measures, etc., etc. Whereas at a more aggregate level, we are happy with mostly gross value added impacts. So this would be like a fairly generic framework as described here. We somehow need to evaluate economic damages. We start from risk parameter values from some initial level. Valuation of collateral LGD, PDs, or default rates, and then translate the economic impacts at some aggregate level through, I have here stress testing models, but it could be also credit rating models to, the risk parameters of interest. So PDs, LGDs, and we do that via, scaling the basic credit risk assessment either up or down, depending on whether a borrower or a sector is more vulnerable or less vulnerable to climate risk. Now turning into my attention into a specific risk type, which is flood risk. This is an approach that is essentially very cost effective. So it does not require a big team. It doesn't require a big budget. It just requires, knowing data sources and a bit of skill. Data sources like Limada have been, mentioned today already. We saw that, it served, say, for the previous speaker in the case of Armenia, as one of the primary sources for a risk assessment. And what such models offer to us are essentially hazard data. So we can say in the case of flood risk, we can over certain time horizons, depending on the version of the RCP scenario, we can get metrics about hazard rates over say 20-year periods. Out of that we can work out our expected damages. We can work out our maximum depending on the purpose of the exercise. So if it's stress testing, one would want to go to an extreme but still plausible event, plausible scenario. So in this particular case, for example, we'd be taking a max over, say, a certain time horizon. Now, one needs to pay attention because, say, in these data, not at every geography the maximum impacts would occur simultaneously. So, another level of complexity that one might add to this is modeling dependence in time, so essentially correlation structure over space and time. But again, that went completely beyond the scope of the exercise. Then the second is, of course, the most challenging. One needs to somehow get geographical information on the type of credit exposure that an institution would have, or from the perspective of the central bank, would want to see the geographical concentration of lending of financial institutions under its supervision. Now, this can be say if credit registry, either at the level of central banks or commercial institutions, are precise enough, one would obtain information like addresses and also, let's say, surface areas of real estate that is pledged as collateral, or surface areas of production capacity, and typology of real estate that is of interest. For example, typically damage functions would differentiate between residential, commercial, or industrial real estate. If this is not available, satellite imaging is the way to go. Again, with modern technology, something that is not prohibitively costly to successfully implement. And finally, there's the literature that would offer, damage functions which are standardized based on. Next slide will essentially say something more about that. So, here an example how. The type of say information that we get from public data sources, and then how would let's say a data input from a financial institution look like. Then what one can do is, so once we have the inputs, we need to find geographical coordinates. There's computer software with corresponding libraries that allow us to do that pretty efficiently and precisely. Combine that with the hazard data set to, say, assign water heights at the selected level of severity. So as I was saying, one can use the max or the average, or you can consider other quantiles depending on the severity of the exercise that one wants to conduct. Then, as number 3, once you obtain the latitude and longitude, the assignment of damage intensity, this is physical meters, 2.5, 2.1, etc., etc. Depending on the property, there's a monetary value per square meter that you get from databases. If you have somehow an estimated surface, it would give you the total damage. That's how one would obtain the estimation of those. Then at this stage, everything is available for further manipulation and integration into credit risk models, because you obtain a table to each, say, borrower asset. There's an allocation of a damage, and you can, further manipulate it. So this slide would just, summarize or explain the same thing in just a different set of words. So just to repeat here, looking at this flow chart at the bottom right, we want to have flood depth from the damage function database, choose the one that we want to use for the purposes of either stress testing or climate risk assessment at the borrower level, and assign damages. The specific case was for Slovenia, but the coverage is much bigger than that. Then how do we integrate this to climate stress testing? We need to essentially aggregate across all the real estate buildings, so collect the damages. Again, this depends on the type of a portfolio. If it's real estate, if it's retail, so residential type of collateral for lending to households, it would be one typology. If we're interested in non-retail portfolios, so for corporates, we'd need to look at the corresponding damages at the production facility and differentiate between, say, office use or industry use. There's intricacies there where one needs to, if the information is not available, to account for multi-story structures, or in case of non-retail portfolios, you can have clusters of different corporates incorporated at one level, and one needs to differentiate between the actual production facilities from the incorporation address. Once those are aggregated, they can be translated into GDP impacts at selected scenarios. And then again, depending on the type of an application, a central bank would typically have a macroeconomic model that can generate conditional scenarios of other macroeconomic risk drivers that are relevant, say, for stress testing purposes, like unemployment, residential property prices, interest rates. So it can generate conditional forecasts of those. If not, again, econometric models like vector autoregressions can be fitted to local data, and then vector autoregressions also allow for conditional forecasts. So this way we can translate a GDP scenario under some climate risk scenario into corresponding scenarios for, say, unemployment rates, interest rates, residential property prices, as I was saying. And those then can be fed into a credit risk assessment model that would, produce trajectories for PDs, LGDs, expected credit losses, etc., etc. So in a bit of more detail, say if we are dealing with non-retail portfolios, GVA shocks would then be translated into predicted, say, financial ratios or macroeconomic risk factors. And then it's applicable to transitional risk, or any other climate risk. And then, those push to non-retail risk models to PD and LGD parameters. If we are dealing with, retail portfolios, of which most of them can be secured, you can, the main, let's say, financial risk driver that would be determining the level of risk would be the loan to value ratio, and for as a PD determinant, or the value of collateral for realized losses in the estimation, which means the LGD. Now, either on sectorial level or on the borrower level, then this would, allow us to create. So what we typically do is we create a rank ordering of, let's say, either sectors or exposures. And because, this is not, it's like a hypothetical risk assessment that one would need to do in view of not yet realized, but likely realizations of climate risk. What is typically a very valuable piece of information, the outcome being similar as the one presented in the previous paper on categorization to different risk categories. One can essentially produce a rating scale. Here's just a simple example that is typically with this traffic light approach into green, amber, and red that businesses like so much. But one can essentially produce a much more granular scale if there's a desire to do so on the side of a commercial or a public institution. So this would be it from my side. If there's any questions, I'd be happy to answer. There's plenty of other additional detail that I have available as well.
Thank you, Igor. As always, the presentations are very informative and very clear and always introduce some novel approach. There's a question from Elizabeth Resch. I would request Elizabeth to just unmute and go for it.
Yes, hello. Thank you very much, Igor, for the presentation. And also the gentleman from the Central Bank of Armenia. It was an incredible level of detail. And I look forward to also reviewing the slides in detail and learning more, because it's very informative and I think really setting a good example for other central banks that seek to replicate that. I am, an economist by training, but mostly I'm working on climate change topics, and so I'm a bit far removed from the financial aspects of it. But I'm very interested in what Mr. Marston presented on the underlying data that you use to compile all of it. Meaning for the building sector, for instance, I think is where you ended it. So could you give a little bit more detail on how you source these? I asked this question also because we advise central banks in developing countries, and data availability is always an issue. But I think learning how you have done it might inspire some alternative approaches. Thank you.
Yeah. So. Let's say Climata is say offering the hazard functions at I'd say it's at the precision of the grid. The geographical grid is good enough for most of the modeling that we want to do at this level. So it's 4.5 or 4 by 4 kilometers. So that's relatively easy. It's publicly available database. There's libraries provided that one can very easily, simply plug and play. Then there's you need to obtain, as you said yourself, it's a challenge to obtain. If you have a portfolio, the easiest is if each to every exposure there's an address, postal address. Then again, you can very easily, using libraries available in Python, say map attached to an address, an exact geographical location. And you position your address into those 4 by 4 kilometer map. If that is not available in the credit registry, either of a commercial or a central bank institution. I mean, if commercial institutions do have them, central banks would also. Yeah, go ahead, Elizabeth.
Sorry, no, go on. I'll ask it
question?
when you. Yes, sorry, no, go on. I'll ask it at the end. I'll let you finish. Thank you.
Yeah, then if this is not available, then one would need to go, and that it's a lower level of lower level of precision. essentially satellite imaging. So with modern technology, you can train the algorithms to distinguish, say, commercial residential property from, say, other areas. And this has been successfully used also in credit risk modeling. For example, when say, wildfire hazard. Okay, you need to, in order to, say, estimate the speed of potential transmission of wildfires, you need to evaluate the presence of public roads, etc., because those are, for example, natural obstacles to spreading out of wildfires, and this is where satellite imaging is being used, and you can equally well apply it to determine the value, the potential impact of, say, floods or river. Or other extreme events on property.
That's so informative. It's sorry that I interrupted you there. It was just because I wanted to ask a follow-up. What's happening in case there's no credit registry, right? Because I think that's the case in some developing countries. In Malawi, for instance, they're only just developing it.
Yeah.
So then.
It's satellite imaging, and then you need to go, and it's a lot of manual labor. You say, this is where the activity is happening. This is where we are landing. These would be the business centers. These are the residential areas, and so on. It's more approximation, but it's let's say it is the way where how you can link damage functions to a specific geographical location.
That's super informative. And a final question, and then I know it's not my event, but it's very, very helpful. So the difference between you said you could use an address, right? If you had an address of a business. So if there's a difference between the business where the business is registered and located and their exposed assets, like if an agribusiness is located in one address, but their fields or their orchards are somewhere else, then I guess that's something that we neglect in these models, right? That the business address is not equal with the location.
Adjustments need to be made. Adjustments need to be made for that, because typically, business addresses would be concentrated in capitals or large business centers, but then the actual production facilities are outside. Just take the example of agriculture. Of course, it's not concentrated in business areas or large cities, but around them, and so adjustments need to be made in this case. For the geolocation.
Thank you.
Thank you very much, Igor, and I hope you could stay a little while to see if there are any questions at the end of the last presentation.
Happy to do so, yeah.
So it's time to invite our next speaker for today, who is joining us all the way from Chile. I would like to now invite Mr. Santiago Lorenzo, who is the head of Climate Change Economics Unit at the Economic Commission for Latin America and Caribbean, ECLAC. He previously held senior roles at the Climate Action Network International, WWF, and the Mexican government, focusing on sustainable finance, climate policy, and environmental economics. Santiago has worked extensively on environmental fiscal instruments, biodiversity valuation, and green growth, and has served on advisory groups including the OECD and GGKP. An economist by training, he holds masters from the LSE and a PhD from Autonomous University in Barcelona. With that, Santiago, the floor is yours.
Thank you, Anand. Good afternoon, most of you. I'm just in early morning here in Santiago, and I'm very pleased to be with you. Can you listen to me properly?
Yes, we can hear you.
Yes, perfect. Thank you. And thanks for also from the presentation from Igor, very illustrative and yes, very in line with what I'm gonna present that we are doing. So my presentation is about how we are collaborating with regional governments and particularly central banks on assessing macroeconomic impacts of climate vulnerability. And I will go towards our work with the Central American central banks that are the ones we are working much more currently, more intensively. And the presentation just left. Yes, can you?
It's coming back on in 1 second.
Yes. This is another one, I think. Well, if you have problems, I also could share it if you want. This is another one. Maybe you have, okay, you have all. Yes, this is. So the structure, as in the next slide says, the structure is that I will talk about very briefly, because all of you are aware of this, how we are starting to use scenarios. Starting, I mean, we have been already 4 years working with the Mexican Central Bank as our it was our learning partner. We start with Mexico, and then we currently are spreading the lessons learned with Central America. So that will be the rhythm. So, a modeling perspective scenario of macroeconomic impacts of climate change, we know that there is a very intense development of the integrated assessment models. All of you are aware of what those implies. Basically, is that we bring geophysical modeling, particularly the information produced by the IPCC, into macroeconomic modeling. And that has changed, is forward-looking scenarios that has changed a lot of the work that many macroeconomic offices in the government are used to do. So this is really something that one of the things that I want to highlight is how the adopting and calibrating these models brings a lot of discussions inside different branches of the central banks, and that's really something that is we should appreciate, and that's something that that is something that improves the way these models are being calibrated, because the perspectives on how when you have the access to some of the formulas, you can really go into more detail and discuss these formulas if they really represent what is happening in the country. So even this process always is very, very necessary, but also very awareness spreading, and also academic exercises that really are, they have different outcomes beyond the model itself. So what in the case of Mexico, the Central Bank of Mexico, maybe you remember, is one of the founders of the NGFS. There were 8 central banks and supervisories that founded the NGFS, and since then they saw the importance to bring the knowledge, the expertise that was being collected and created by the NGFS into Mexico. And one of the models used by the NGFS, the GCAM particularly, they have data for Mexico specifically, because some other models did not have that granularity for Mexico. So that was one of the reasons why GCAM was selected as to be adopted and adapted and calibrated in the case of Mexico as the integrated assessment model to follow. Also because it has modules on land use, and that's very important for mitigation and adaptations in Mexico. Let's remember that in Latin America and the Caribbean, and particularly the case we're going to see of Central America, are really vulnerable to climate change, highly vulnerable. And on the other hand, all in all, including Mexico and Brazil, that are like the largest countries in the region, the largest economies, the whole continent do not contribute beyond 10% of the greenhouse gases emissions. So the most important issue for the region is physical risk. So, but in any case, land use represents opportunities for mitigation and adaptation simultaneously. Also, there were other two models that were developed in this effort in the Mexican case, in the Central Bank of Mexico, Banxico. One is about these vulnerabilities. The clean risk is a model that has been developed by the Free University of Amsterdam with the Mexican National University. So it was very at hand with a lot of information of Mexico because it's developed by the Mexican University, and it has some of the features that Igor was telling about the models that Ecolab is using. And then the complement also to these efforts to have an integrated assessment model like GCAM and the clean risk that is a geographical platform as well. The GEMS model developed by the Agence Française du Développement. It is more macroeconomic, and it would helpful to translate GCAM findings into macroeconomic aspects, and also to explore a little bit more on a shorter term, because GCAM is much more structural on the mid and long term, the information produced by GCAM. So all in all, these three adopting, and calibrating these three models and bridging them has give a lot of possibilities for the central bank to assess the climate-related risks and opportunities. And obviously, the transmission to the financial system as is being done as well. A module about that was created. So the model suite is these three models. The GCAM, as you can see, is it has feature nine consumption energies: electricity generation by technology, cost and prices, transportation services, energy used by transportation technology, and fuel used and land use, as I mentioned, biomass, cereals, forest. This is here also important for the central bank because the last 25 years we have witnessed that most of the increases on raising prices in the basic consumption basket is driven by food and agriculture, and having this potential forecast on heat and floods and droughts give a lot of information about how this can be driven further up. So it was really interesting about that, and the Central Bank of Mexico was keen on getting more information about the impacts of climate change in the food value chain. Also water extraction, that is totally related with that. At the same time, the clean risk gives us in a frame of 50 to 50 kilometers information basically driven up to rain patterns and warming temperatures. And also it gives information about the heat islands of in cities that is important for other purposes that is relevant for central banks, and the macroeconomic model gems. And so all in all, that's the model suites. With these models, the central bank decided to develop the scenario below 2 degrees, the current policies, the delayed transition, and one particular that is not related with any NGFS scenarios, that is the asymmetric scenario. The main assumption is that Mexico do not follow any climate action, and the rest of the world does. So it's like a climate laggard, and that was made just to see how this create additional risk for the Mexican economy. And yes, it obviously it brings further potential risks that are important to consider. Also to make the case for climate action. So the GCAM system is, you have it here. I will not go into detail, but brings a lot of information on the energy system, but also, as mentioned, and as a critical information for the Mexican case and also for the Central American case. It brings information about the land use system. So that's important for most of the region, Latin American and Caribbean. Also, the climate risk brings different features, the exposure on socioeconomic module, and also in the hazard is done by a climate model. And then you have the vulnerability and impacts with the economic impacts model, then the risk evaluation model, and the sectoral impacts model that you use different formulas and information. So this climate risk that is the main that the Central American banks wanted to get because of what mentioned, the vulnerability of the region, is especially explicit with, as mentioned, is with 50 kilometers by 50 kilometers, then comprehensive damage functions with a variety of damage functions that incorporate aspects such as local climate change in cities, the persistence of economic impacts, and catastrophic climate change, and has an unique upscaling, downscaling approach that is is being driven by the team that developed this model. Also, as the effect on cities, that is particularly important and relevant because the region has 80% of the population is urbanized, and that implies also with a lot of informality in employment and economic activities. You can calculate some impacts derived from this increased heat that is felt in cities. Then the probabilistic global and regional climate projections that emulate 37 Earth system models included CMIP6 and for producing probabilistic regional changes. Then we develop socioeconomic scenarios. We integrate process basically integrated assessment models, and we have identification of hotspots thanks to the granularity of the model. Then, in a nutshell, also the GEMS, to describe it a little bit, is a stock flow model, and it's very dynamic. As the stock flow is a disequilibrium model that is much more adequate for this region economies that unfortunately equilibrium is not a feature very often achieved. And stands in the middle of a poor theory and data. It's a very you have to work this model very in depth, so it takes around 2 years to calibrate. It's a lot of work. It's very work intensive, but in the same time it brings a lot of learning for the teams that are that develop this they adapt the gems to the local economy. So since the experience with the Mexican Central Bank, there was fortunately we have the chance to put together the Mexican Central Bank experts with experts of Central America, and thanks to the Central American Monetary Council that is the body that coordinates as central banks and the supervisor and has good relations with the supervisory intendency of for banks of Panama. And also we work with the central bank in Dominican Republic. So all the ensemble participated in sessions with the Mexican Central Bank and with the teams of the Agence Française du Développement, with the universities in charge of climate risk, with our experts in ECLAC, and they also have been benefiting from the work that with GCAM, the University of Martin as the host of the GCAM and developer of the GCAM has transmitted to them. And also in this effort, we have been joining forces with the World Bank and the financial stability, financial system mitigation and adaptation tool, the FSMAT, that is inspired in GEMS, and thanks to all of that, the members of the Monetary Council have been under training, but the emphasis has been put on physical risks because obviously the contribution of for mitigation, the global mitigation from Central America is really negligible. They understand the benefits of mitigating, that's not a question, but they really prioritize physical risk. And the objective was share Mexico the progress on developing these tools. The outcome so far is the creation of a working group by different officials of the central banks of Central America. And the group entails staff from Costa Rica, Salvador, Honduras, Guatemala, Dominican Republic, Nicaragua, and the Superintendency of Banks of Panama. The work is generate training spaces and develop capacities in-house. So far, the outcome is that they have done a damage function for each of their countries that is going to be published at COP30. This is a first step to develop much more capacities with climate risk in principle, and also the GEMS tool also. Well, the FSMAT will be adapted probably at the end of the next year. The good thing is that also we are working with COSEFIN. COSEFIN is the sister body of ministers of finance in the region. As in Mexico, with the central bank, also has been done the work with the Committee of Sustainable Finance, that is work that they do together with the Ministry of Finance and other regulatory commissions of the financial system. In the case of the Central American banks, also the idea is working the same stuff with the Ministry of Finance. Why is that? The central banks, as you're aware, because you you are one, you have much more capacity on economic studies. Ministry of Finance usually are attending much more immediate tasks than and the capacity of doing more in-depth research is very limited. So, but on the other hand, the findings of the central banks, many of them can speak to not only monetary policy but also to fiscal policies, and then reduce the risks that are reflected in these models. So having the central banks and the Ministry of Finance working together brings a lot of possibilities to reduce the risk. Right now, another point that is happening in Mexico is that today a pilot, as Igor mentioned about climate stress test, a pilot on climate stress test is being carried out with a dozen of financial institutions, and also this is a learning that will be transmitted into this Central America central banks as well. Once we get the outcome and the lessons learned, and see how we can enhance capacities on this financial system, that will be also transferred to the Central American banks. So all in all, it's been a joint work with a partnership with Mexico to support the central banks of Central America. But yes, at COP30 we will have a publication on this function damage function. Sorry. And also that another outcome that was already published and is let's say a collateral benefit of this partnership is the monetary and financial policy in Central America, Panama, and Dominican Republic, facing climate change challenges and advances and opportunities. This is a collection of what these central banks are already doing on monetary policy and the advances on this effort of modeling and different, particularly physical risk, and also the approach to the transition risks. As mentioned in the previous presentation, with the question with Elizabeth, one of the features that is clear now for Mexico, but also is a learning from Central America, is that the need that the information collected by central banks on where the finance is going, where the lending and the bonds are located, usually gives precisely that. No, everything is allocated in the as Igor mentioned, in the large cities and the central financial hubs, and but it right now is very likely, very possible that even not only by postal code, but also you can give coordinates with a simple cell phone. You can get the coordinates of where you are, what is the economic activity taking place, and how much of the money borrowed goes to this particular location. So one of the things that is being conversed in the conversation is precisely that much more geo-referentiated information can be asked for the clients, and this is a conversation in particularly in the Mexican Banking Association. All the banks says, I don't have any problem to ask that, but I want all of us to agree that all of us will ask for that, because that implies that it is an additional burden to the client to ask for this information. But if we all do it together, no, that is not as an excuse for my client to go with my competitor. No, so this burden is bear by everyone. So and that's very important, because once you have this information, you have much more clarity on the physical risk and the materiality of those, as Igor was showing with the floods case. So this is a decision that also central banks, as financial regulators, can already take to demand all the regulated financial institutions to, at the same time, to ask their clients on the location of the georeferential location of the financing. Well, I'll leave it here, and I'm open to any questions. Thank you very much.
Thank you very much, Santiago, for the very interesting presentation, and it's especially very nice to hear the perspective from the Latin American region. With that, now I think we have some time left for consolidated question and answers, and may I please request the other presenters who have still made it this far to switch on their cameras, and the audience to direct any questions for Santiago as well as from the previous presentations. May I also remind the audience that there is a link to a feedback survey in the chat and also QR on the screen. We would specifically request you to provide your feedback that would help us tailor these events better in the future. So I think in the chat there was a question for Ms. Urgamal. If I may, I start with that. Ms. Urgamal, Elizabeth asks that to estimate credit risks and classify mortgage loans, which data did you draw on to locate the loans? Data from financial institutions, or is there a credit registry? And can you share what data you use to identify exposed at risk areas?
Thank you. Thank you for the question. So we carried out the bottom-up climate scenario analysis. So it means technically, it means we collected data directly from the financial institutions or commercial banks. Also, on the other hand, we don't have good credit registration bureau registration system, so we don't have the good data on that. So basically, we collected data, loan exposure, loan outstanding, as well as the credit risk parameters from the commercial banks at the sector level. Regarding with how to define the flood risk exposures, the exposure, varied or diversified flood risk zones. Luckily, we found a very good research paper, which is conducted by the National Emergency Management Agency in Mongolia on the National Disaster Risk Assessment of Mongolia. From this study, we are able to have flood risk map, which is a very compound risk indicator reflecting risks to population, households, house area, dwellings, education, health facility, etc. So it was very useful information, this flood risk mapping for us, as well as for banks. So we asked the banks to classify the mortgage loans and all corporate loans collateralized by the real estates to classify based on this flood risk map, because it's more the flood risk map is specialized geographically more small units of the administration of Mongolia. So they classified all loans based on the collateral, so geographically, then aggregated into the sectoral level. So of course, it's a lot of labor for the banks. It takes, I think it takes more than 3 months or 4 months. So hopefully I answered the question. Thank you.
Thank you, Ms. Urgamal. I see that we have 2 minutes left, so any final questions from our audience? So I think it's a good time to bring this event to the close. The Greening Central Bank's Peer Learning Series actually aims to create a space specifically for central banks and regulators from across the globe to meaningfully engage in this peer learning, share experience, and promote South-South and triangular cooperation. We hope that this space that this initiative has created provided you today with meaningful insights from real-world cases from Armenia, Mongolia, and from Latin America, as well as technical direction on various ways how climate risk modeling and assessment can be undertaken. As Greening Central Bank agenda, and especially the integration of climate risk considerations in supervisory and regulatory frameworks expands further, we hope to engage with you again and bring more such case studies and useful technical information to the table. On behalf of all the hosts, NDC Partnership, Agence Française de Développement, European Investment Bank, and United Nations ESCAP, I express our gratitude to our wonderful presenters, Ms. Tina Mambaksh, Mr. Jejija Kashinora, Mr. Igor Matson, and Santiago Lorenzo for their valuable time and insights. I would also like to thank our representatives from the two central banks, Mr. Ashot Petriosan and Ms. Urgamal Vasudnanjid, for sharing their valuable experiences. And finally, it would not have been possible without the continuous support and a lot of hard work put together by our colleagues, Mr. Adrian Froles Aguilar and Ms. Morgan Nightingale from the NDC Partnership, Ms. Dragan Atanasic from the European Investment Bank, and Ms. Lucy Charrier and Lise Giral from Agence Française de Développement. On behalf of all the organizers and co-hosting organizations, we thank you again for your participation, look for your feedback, and hope to engage with you very soon. Have a wonderful rest of the day, afternoon, and evening. Till next time.
Thank you very much for the invitation. Bye bye.
Thank you. Thank you very much.
Thank you all.
Thank you.